Welcome, everyone, to this week's Sunday Macro Wrap-Up for Sunday, February 1st, the first day of February. Man, already the first month of 2026 is down. We are zooming through this year already with a pretty crazy last week of January last week with the Fed chair decision, as well as we had an FOMC press conference where they paused their interest rate cuts for the third time, as well as we have a government shutdown again. So lots of interesting things going on, a lot of sentiment being driven by the headlines, which we're going to get into here. But the title of this video is focusing on the crash on Friday in precious metals, right? Everyone's talking about the huge record decline in silver and gold. And so we're going to be getting into that as well as some of the things coming up this week. Still a pretty busy week in terms of macro. So we're going to be getting into that as well as much more. If this is your first time joining us for the Sunday Macro Wrap-Up, welcome. The way that these work is that they're an hour long. The first 30 minutes is streamed on our social media, and the last 30 minutes is actually offline with our Macro Optics members. And so if you guys would like to learn more about our different memberships, you can go to our website, macro-optics.com, and check out our couple of products there. One is a once-a-week newsletter, and then we also have our partnership circle. But we're continuing to do our 6-week challenge, which will be kind of like an ongoing cohort, just because we saw an enormous amount of success with that, with a lot of people enjoying, learning and implementing our macro process, so that they can stay ahead of a lot of these different, trend shocks like we saw this week. So if you guys want to learn more about what we do and how we're helping our other members learn how to incorporate macro within their process, then I would highly recommend checking that out. If you already have a group that you're a part of that is helping you with macroeconomics and understanding a lot of these different market cycle trends, great, stick with them. If not, come check us out, and we'll be more than happy to help you out there. But let's go ahead and get right into it here. Go ahead and share my screen. This is the two memberships that we have, but let's go ahead and get cracking on. All right, so this week we had a FOMC press conference, and this was for the first Fed meeting of the year. And what was interesting was that we knew that, looking at the futures market, that there was going to be a pause, but we didn't know the exact rhetoric or the context in which they're pausing. And there had been other Fed governors who have been a little bit, talking about more of continuing to cut. Other governors have said, we should just, pause from here and wait and watch. Ultimately, the decision that they went with was with this hawkish pause, holding rates at 3.5%. And what was interesting is that they delivered an upgrade to the economic outlook, right? So, for the past few meetings, they've been talking about a resilient economy with a pretty terrible labor market, which is the reason for the cuts. But this is actually the first time in pretty much 6 months where they upgraded growth to solid, quote unquote, and they completely removed the critical warning about the labor market, right? And so that was a huge jump from the meeting that we saw back in July of last year. And so this was effectively ending the entire employment scare of 2025, right? And what was also interesting was there was, like, out of the entire hour and a half, there was probably 2, maybe 3 questions, but somebody asked Jerome Powell about what he thought about oil prices. And he continued to double down on saying that, this acceleration in oil prices, as well as 5-year break evens, you don't have to worry about them. This is all because of tariffs. And we've decided that this is just a one-off inflation spike. And then after the tariffs have been worked through, we're going to go back to the disinflation, right? Now, you have to remember, Jerome Powell, whenever he gets on TV, the only thing that he cares about is the way that they look, right? Their reputation, blah, blah, blah. They always talk about, hey, we're for the American people, our dual mandate, stable prices, full employment. But that is just a way to, make the market feel warm and fuzzy. Or really, all they're trying to do is just, maintain face. Um, and so you have to read in between the lines there whenever you're listening to him. And, you can go through, and we did a whole live stream on that day. He was lying all the time. It was pretty clear, the lies that he was telling. And so it was very interesting him just completely ignoring these historically leading inflation gauges, which we wouldn't see this show up in the real data until probably around Q2. Um, and we're still right now even getting through a lot of the different data from the first government shutdown that was like a record long, right? And so we're still getting a lot of that. They're blaming a lot with the government shutdown, but they essentially were able to pause here without really disrupting too much of the markets. But what was interesting was when you take a look at the futures market with what it's pricing in, still no cut in March, still no cut in April, and you're finally starting to get a little bit of a chance of a cut in June. And then after that, no more cuts until around December. So when you take a look at what the Fed Fund Futures is pricing in, it's just one cut in June and then another cut in September, and then zero cuts from there on out. So not even anything, throughout 2027. And so the futures market is essentially declaring that the Fed's neutral rate is between that 3% and 3.25%. That is a lot higher than 0%, which is what the Fed funds rate was for the past 15 years from 2008 up until COVID in 2020. And so with us being in a much higher, debt environment, I don't think that this administration, Trump and his team are going to get the, 1% Fed funds rate that they all want. Even if they, hire someone who, Trump seems to like, even though he's been historically a hawk, which was this week's announcement, which is that Kevin Warsh is going to replace Jerome Powell as Fed chair once his term expires. I think it's in May or in April. I forget when. But, the market was having a little bit of a reaction with this because typically in past comments, Kevin Warsh has been more of a hawk, meaning that, he really wants to tackle inflation. And he is typically in favor of keeping rates elevated until you see a substantial move in inflation, which we still haven't, right? I mean, inflation is still ranging between 2.6 and 3%, which is a lot higher than 2%. And so the market was having a little bit of a reaction to this, and a lot of people were blaming this on, or were blaming the drop in gold and silver on this, which is completely false, which we'll get it to here in a second. But that in combination with this government shutdown, which likely will end on Tuesday, a lot of this was just stirring up a lot of the volatility with those things. If you take a look at the betting markets from Kalshi.com, you can see that right now it's pricing in that the government shutdown will last around 4 days. So this isn't anything like another, shutdown Armageddon that we had, from November to December. This is looking like it's going to be pretty much a pretty short government shutdown. So famous last words, though. That's what we said last time. We'll see what happens. But just a lot of disruption in the news this past week. But what's interesting is that when you take a look at a lot of the different things that the market was trying to price in, which namely was the credit risk markets, right? So when taking a look at bond volatility as well as the volatility index of the S&P 500, both of those remain pretty stable, right? And then also as well, when taking a look at credit spreads they did have a little bit of a jump, but still remaining at historically low levels, right? So in terms of actual credit risk in the markets, it was pretty much mild to muted, right? Even with all the commotion that was going on. What we did see was a huge spike in gold volatility as well as silver volatility. And this ramp up here was happening a couple weeks beforehand. And, while most people were chasing this huge spike here, the thing to do, especially with people in our group here, with our trading range model, as this starts to clip the top end of the trading range, those were all times to, take profits on this thing, right? Because you did have a little bit of a consolidation period from October till about late November of last year before it had its huge breakout. But when it starts to clip the top end of the trading range, you're just slowly taking profits, not completely exiting the position, but it allows you to not have full exposure when there's large price corrections like this. And at the same time, as silver was ramping up, you should have noticed that silver volatility was also ramping up too. And when volatility ramps up like that, I mean, it's kind of like a hot potato, you know, or it's kind of like a game of musical chairs, right? You want to keep the cards tight to the chest, and you want to be a little bit more active once volatility spikes up like that. So that's what we were seeing for both gold and silver. Silver did end up downgrading itself from bullish to neutral. It's not yet bearish in our model, but there were other better things to buy in terms of the precious metal space. Um, we were holding off on gold as well, although I know some people were buying it, and that's okay. Gold did maintain its bullish trend, but mainly the ones that we were talking about in our group here on that Friday close were things like copper, as well as uranium. So those were the two that look a heck of a lot better than gold and silver. So yeah, if you were part of that group who was getting sucked into silver here and instead and you weren't taking profits, then just take that as a signal, meaning that you have room for improvement, right? It's okay. You'll have other opportunities. This isn't the end of the world. Um, but this was mainly just a huge crowded trade that ended up just flopping over, right? This wasn't because of any type of Fed announcement or anything like that. It's just a crowded trade in a volatility spike, and that's what happens. And commodities still are a pretty volatile asset class. So, um, what we also talk about in our group is sizing positions, right? So, in the case of commodities, that wouldn't be as big of a sizing in your portfolio than something like, currencies, for example, or bond ETFs, or even ETFs for that matter, right? So commodities can almost be analogous to cryptocurrencies in that sense, you know. So yeah, metal volatility and the unsustainable liquidation that happened, that's really what was causing this, right? And again, when we take a look at credit markets, when we take a look at broad market volatility, those remained relatively stable. And so yeah, I mean, for a lot of people, well, not for a lot, mainly for a lot of people in our group, it was a great buying opportunity for things that were having a decent dip, mainly with like small caps and things like that. And it was a great time to actually buy. So that's the position that you want to be in when most people are freaking out. You want to be in that position to actually buy things. And so that's what we were doing. Also, as well, when taking a look at Bitcoin over the weekend, it's been having a pretty decent drop. It was interesting over the past few weeks how Bitcoin did go bullish in our model for a couple days. And then once it had this dip here, it went back to bearish trend. And we were telling people to get out on this dip here on the 21st. Good thing, because this decided to go down an additional, nearly 15% since then, right? So when something breaks trend, don't even think about it. Just axe it. Get out of there, especially with high volatility assets like Bitcoin and other cryptocurrencies, right? Look at XRP. This thing had a huge pump. It was in bearish trend. Get the heck out before it starts bleeding even more. So it's these types of signals that we provide to our members. So if it's something where, you're feeling the opposite or having any type of feelings for that matter, I would highly recommend checking us out so that you can have some firm confirmations and answers based off of what our model is showing, right? So, yeah, that's really the bottom line with all of this. Also too, lastly, when taking a look at the United States yield curve, this actually just put in a new high for this bear steepening twist. And we talk about this before in previous Sunday macro wrap ups, as well as we talk about this all the time in our community. But taking a look at these twist signals in the yield curve. Now, a twist is, well, let me back up. So the yield curve, right, is the difference or the spread between the 10-year US government bond yield. So let me scroll up here. So we have the 10-year US government bond yield, which ever since the Fed started cutting rates, it's gone up, which is ridiculous. But it's the difference or in percentages or the spread between the 10-year versus the 2-year US government bond yield. Now we go into this more detail in our community, but just for a quick reference, the 10-year US government bond yield is the bond market's way of, trying to price in future growth and inflation, right? You can almost think of the 10-year as the macro signal, whereas the 2-year is the bond market's way of pricing in Fed policy, right? Whether they're going to be more hawkish or dovish. Typically, when the Fed is more hawkish, you have a bullish 2-year. And then conversely, when you have a bearish 2-year, that's typically when you have a more dovish Fed, more likely to cut interest rates, which is kind of what we've been seeing, right? Over the past, since 2025 began into this year, even though it's kind of halted. Interestingly, once they started actually cutting interest rates, the 2-year stopped going down, which is pretty funny. That's why it's a leading indicator. But typically, the 10-year yield and the 2-year yield work in parallel, but there are some rare instances where they actually move in opposite direction. And that opposite direction is called a twist in the yield curve, right? When the yields are moving opposite or anti-parallel. And so typically, these are the four phase signals that my team and I like to characterize for the yield curve. And the whole reason for looking at the yield curve is that the bond market is the smart money. It's a way bigger market than the stock market, right? They say that the stock market is something that front runs the real economy. Well, the bond market front runs the stock market, right? So if you're going to be looking at like what the smart money is doing, look at the bond market, and that's why we pay attention to the yield curve. And typically these are the four signals. But like I mentioned before, when you have these rare twist scenarios, that's when you really want to be paying attention, because they don't happen very often. And they're typically a transition period for something much larger. And when taking a look at the yield curve indicator here that my team and I created, it's a free indicator on TradingView that you can download if you search me up at Johnny Zerdy on TradingView. Let's see. Yeah, if you just search me up here, and then you go to scripts, it's this one right here. I have some other private ones too, but that's only for members. But when you take a look at this table here, you can look at the current phase at the top one, and we see that the 10-year performance is green, over 4%, where the 2-year is at a negative 1.86%, which is technically a bear steepening. I might need to update this to actually put in the twist in there. But we're seeing this continued bear steepening twist, right? Where the 2-year is falling, but the 10-year is going up. And this isn't a end all be all. This is a like a rule of thumb. But typically, when you have a bear steepening twist, This is when we see an inflation spiral, maybe later on, right? When we're starting to get those indicators with the rate of change of oil and 5-year break evens accelerating. But also, too, we have a huge loss of faith in the dollar, which is something that we're seeing, right? With the huge drop that we saw over the past few weeks. Credit spreads are widening. We're not seeing that yet, right? They're more so with this bull steepening twist. They're still healthy. So we're not yet seeing any type of huge debt concerns with credit spreads. Fed policy is typically dovish. Well, they just transitioned over to hawkish. So that's pretty interesting. Fiscal policy. So the government is typically doing reckless spending. They're blowing out deficits. That's happening for sure. Sentiment, overheated, distrust, that's happening. Bullish assets are typically hard assets like metals, gold, real estate, and crypto. Crypto's not bullish though. So again, this is just a rule of thumb, but in general, what the macro is typically suggesting is that there's a huge loss of faith in the Fed's credibility, right? And you could have a potential inflation spiral, which again, we're starting to see possibly the beginning of right now. And so we really need to pay attention to the next few months from here. But, it's not just me saying this, right? Where did that one? Okay, yeah. So this was the article that I had beforehand, right? Jerome Powell got a direct question about U.S. losing credibility and the soaring price of gold and silver, which he didn't really answer. Right. So it's interesting how our yield curve phase signals are talking about this loss of faith in the Fed. And, Jerome Powell is avoiding these types of questions altogether. Right. Jerome Powell right now, by the way, is kind of like, when you're a senior in high school and you have like 3 or 4 weeks left before the end of your spring or the last year. Typically you're just fooling around a lot. Well, I mean, that's really what he's trying to do. He sees the light at the end of the tunnel, and that's all he really cares about. And so he's just trying to, save his credibility until the end and then just pass the buck over to Kevin Warsh. So, um, so yeah, I mean, that's really what we're seeing right now. In other words, my team and I, we are fading the entire, bearish fear mongering that's going on right now, and we're just sticking to our process, which is whatever bullish trends are having corrections, we're just buying them. If things are breaking trend, like something like silver, then we're no longer buying them. And that's really all you need to know in terms of making money in the markets. A lot of people like to have a lot of this data that they're looking at in the news, blah blah blah, but really it's like, what's your actual execution doing? Right. So, so yeah, that's what we saw last week. This week coming up, we have the ISM manufacturing PMI tomorrow at 10 a.m. Pretty busy week. Then we have JOLTS on Tuesday, job openings, labor turnover survey. And then on Wednesday, we have the ADP non-farm payrolls. That's the private report for payrolls. And then later on that morning, we have ISM services PMI. Pretty important. And then on Friday, we have the January jobs numbers, as well as the unemployment rate. So this is a big week. Typically the first week of the month is where you get a lot of the labor data update. It's typically jobs week. And then also too, the ISM manufacturing PMIs and services PMIs. So pretty big week in terms of data dump, as well as when we take a look at earnings, we're finally entering the meat of earnings season, where tomorrow evening, Palantir announces earnings, and then tomorrow morning we have Disney, and then on Tuesday we have AMD and MRK as well as Pepsi. Wednesday is when it really starts to get big with Google announcing its earnings that evening after the close on Wednesday, and then after the close on Thursday we have Amazon. So two of the big Mag 7 stocks. And then Friday morning, we have Philip Morris PM. So those are the real big ones. But really, it's Wednesday and Thursday with Google and Amazon, respectively, there. So we're starting to really ramp up earnings season. And so, yeah, I mean, it's another big week of announcements. I'm not sure how it'll play out with like news headlines and things like that. But again, even if let's just say Google and Amazon miss earnings and there's some type of sell off, the big thing that you need to look for is okay, if things are correcting, what assets are still maintaining their bullish trend even with the correction? What is volatility doing? What's the volume looking like with a lot of these different things? Right? All these questions you should be asking yourself in real time in order to give yourself confidence of okay, is this a dip to buy or is this a dip as a warning sign to stop buying or even get out? Okay. And if you have a process for that already that is working for you, fantastic. Keep doing that. If not, and you'd like to learn more about how to incorporate macro with that process of executing, then I would highly recommend taking a look at our Macro Mastery Challenge. We have the enrollment registration still going on for the next couple weeks, and I would highly recommend you guys check that out. Cohorts will typically go every couple weeks here. So make sure you grab your spot there, book a time with myself or someone from our team, and we'll go over all the details there to see if it's something that would help you out. But we're approaching 30 minutes here, so we're going to go ahead and end the live stream, but we're still going to continue this discussion offline for our Macro Optics members. And in there, we're going to be answering questions, going over different types of actionable ideas. So all this information that I just went over, how do we actually put that to the paper, right? So we're going to be discussing that all in the second half here. And if you guys would like to join that as well, just go to our website. I think we have a free trial going on. So yeah, go ahead and check that out there. But it's going to be an exciting week. I appreciate everyone for joining here on our stream. For those who are on the Zoom call, stick around. Let me go ahead and log off on the stream here. Wave goodbye to YouTube, TikTok, Instagram, and whichever platforms else we are tuning into. And we will catch you on next Sunday's Sunday Macro Wrap Up. Bye, everyone.